Now, I want to welcome now on the show the next set of panelists. I have with me Mr. Subhash Chandra Garg, former Finance Secretary of India, Arvind Virmani Chairman of EGROW, and Rituparna Chakraborty, Executive VP and co-founder of Teamlease. Welcome to all of you and thank you for speaking with us. Mr. Garg, let me start by getting your take to the broad question that we're asking on the show this evening. How real is it? Plenty of indicators to show that September has been a good month. On the same day, we've also had the World Bank now forecasting a dip in our growth for FY21 compared to their projections earlier. What is the true picture that you see emerging?
So we are now in the month of October with most of the economic activity lockdown having been unlocked. The remaining activities are getting unlocked from 15th of October or so. So by and large, the entire economy now is allowed to operate normally. That, to my mind, is the biggest sign that we are trending towards the normalcy. But there are many factors. There are many trends which make one sector differ from another. There are sectors like information technology, even vehicles, and some where the growth is better than the last year because a lot of work has shifted from, and a lot of new value addition is coming from the further services and activities which the sectors like IT are seeing. But there's still many sectors like entertainment, sports, travel, tourism, etc., which are nowhere close to the activity of last year. We had the August number about the core industry, which still continues to be lower at about 8 to 9%. So what I see at this moment is that we are very close to being normal in the aggregate, but still there are sectoral differences. My sense, as I had spoken to you last time also, that in October to December quarter, we should have still a small contraction compared to last year, maybe of the order about 5 to 7%. Agriculture continues to be very good. This has been a good monsoon. There's been also a lot of fund infusion by the government and all, and there has been much more demand for the agricultural products in this COVID kind of thing. So agriculture continues to do well. Manufacturing, construction has come back to fairly normal, but still a lot of services remain subdued. So on the whole, near normalcy, but not still normal.
Mr. Garg, when we spoke last, if I'm not mistaken, for the second quarter, you believe that there would be a 10 to 15% contraction compared to last year. Are you changing your estimates after looking at what's happening in September?
No, I think I stick to that for the second quarter, July was not very good. August was also bad. Still, see a lot of subterranean. We see some of the highlights which look like saying that a lot of activities have got normalized. It's now getting, but I think on the whole, still, if you take everything together, we would have a second quarter contraction between 10 to 15%.
Mr. Virmani, what is your take on what we're seeing? And I know the high frequency indicators are really not cast in stone, but there seems to be a sense that the cloud is lifting. Is that just a lot of what we're seeing in headlines, or do you think that there are real signs that the worst could be behind us, that our recovery has been faster than what was expected, especially from the month of September onwards?
So when we talk about recovery, it is very important. And we are to the question really becomes recovery to what? So what do I mean by that? When the GDP numbers came out and the subsequent IIP numbers, everybody said we are adjusting the whole mean said we are adjusting it from -5 to -10, right? So the question now is we are 2 or 3 months after that, what is the perspective in which we are saying, is there a recovery? Are we talking about recovery to minus 10% for the whole year, or recovery to minus 5% for the whole year? In fact, the people I've heard over the last 2 weeks are saying, oh, it could be much worse than minus 10% for the whole year. So, the bottom line here, as far as I'm concerned, this definitely shows that we are recovery to above minus 10%. Not clear to me yet. My original forecast for the whole year was minus 5% plus minus a huge range, because things are so uncertain. So moving up definitely above minus 10%, but not very clear whether we've gone above minus 7.5% or so. So yes, there is clearly a recovery. It depends on your perspective. I think those people who were predicting for the overall year minus 10% or less are going to be wrong. Now, I'm giving you the bottom line first, but I would like to tell you there are 3 dimensions which our research I have been pointing out. I don't think you had me very often, but we've written 6 papers on this whole issue, the question of pandemic and lockdown economics. And there are 2 basic dimensions which are very important and are also important for judging the data. So the essential goods and services are roughly 40% of GDP and 55% of employment. These have been functioning more or less smoothly, and the data, whatever we have so far, tells that several of these are operating now at a much higher level than a year ago. So those were not locked down, they are functioning, and they will continue to recover at a good, decent pace. The second one is what we call contact services, which are affected by the overall pandemic, which will continue to function badly. If you look at GDP categories, this is other services, which are part of government, defense and other services. Just the other services part, restaurants and hotels and retail from the GDP thing. So whenever you get data on that, keep them separate. They are 10% of GDP, 10% of the employment. Okay, so that proportion is very, very important. You can't take something bad which is happening in this 10% and apply to the whole of it. And then the critical sector, manufacturing, mining and construction, which is roughly 60% of GDP and 45% of employment. Watching or hearing on TV what your previous person was saying, really what are surprised, I am not surprised, because we had talked about lockdown as affecting this sector the worst, and that we would go from a transition, there'll be a transition period, and we had said that by the last quarter of this year, we would be close to normalization, which you could define as 100% roughly of what it was the last year, plus minus 5%. So what is surprised many people is how quickly this is recovering. We are not surprised. But as I said earlier, that we are in the transition. We've just had 1 quarter, at least another quarter of transition before we get full normalization of this sector. So that's the perspective in which you should judge the data.
Okay, let me bring it down to how it impacts people. Sometimes when we look at the economic data, it becomes quite esoteric. So, which is why people cling to tangibles, things like auto sales, or another very key factor, which is why I was keen to talk to Rituparna today, is salaries. We've been talking, Rituparna, about unemployment levels. And the latest data that has come out from CMI that everyone follows and tracks has shown that a significant number of white-collared professional jobs have gone since April. We know that there have been pay cuts in different industries, and there have been job losses as well. But now we are hearing, and that too from major companies, HDFC Bank, Axis, TCS last evening during the, talking about their numbers, that they are going to hike salaries. What are you seeing and hearing in terms of actual salary payouts?
Yeah, thanks, Tamanna. I think I feel that we should keep aside the extremities in the circumstances, because there are extremities in the current environment. But if I were to look at, by and large, the general trend, we are just about in a situation where organizations are looking at revoking the different levels of pay cuts that have happened. In some cases is a complete revocal. In some cases, we are also noticing a trend of partial revocal because needless to say, there is a cautious optimism in the air. The reason for that is, honestly, no one really knows what phase of the pandemic we are in. It's very difficult to say whether we are at the beginning of it, the middle of it, or at the end of it. And definitely we are seeing that caution in organization when it comes to hiring and when it comes to decisions around wages, because people are definitely not willing to make upfront investments until and unless there is absolute certainty that some of the green shoots that people are observing are here to stay or not. There is still a question mark in some organizations, in different sectors, about the predictability of consumption and consumer behavior. And maybe that is playing a role in terms of this cautiousness. However, what we should take, the positive news is that there is now a sentiment where organizations are moving forward from their extremely conservative stance in terms of hiring, in terms of revisions, in terms of pay cuts, and so on and so forth. So there is definitely a positive shift, but I don't think it's time for us to celebrate around that yet, Tamanna.
Fair point. Mr. Virmani, that's yeah. I think a key word that Rituparna used in a different context, of course, was cautious optimism. And do you think that is warranted right now? Cautious optimism. You talked about the service sector and the highlights of the service sector sort of overtaking everything, but that's where most of the jobs are, the higher paying jobs are. And that is what has defined the growth engine for the Indian economy for the last couple of decades, hasn't it?
Yeah, so let me, you mentioned CMI data. So it's very important to have an analytical framework, which is what I was trying to tell you. Let me illustrate that with the CII data. So what our analysis has shown is that if you take what I call normalization, you take the ratio of the unemployment rate in whichever month and divide it by the unemployment rate in the same month in the last year. If that number is at 1, that means you're more or less normalized as far as that unemployment rate is concerned. And let me give you very quickly some numbers. So this ratio in March, when the pandemic started, was 1.3. Okay, so you get a jump from February 1.1 to 1.3. Then next month it goes up to 3.2, and after that 3.3. That means the unemployment rate jumped to 330% of what it was last year. Okay. Now here's a story which you are missing out, and that is in June it comes collapsing. It goes right down to 1.4, and in July and August it is 1. It's the same unemployment rate which prevailed in the previous month. I haven't done the same for the September number. In fact, I was just looking at it, but it doesn't matter. Now that's not the full story, but it just tells you that some of the reports we were seeing were highly exaggerated. Some of it is temporary employment. Okay. Now there is another phenomena. I don't want to leave you with the impression that I'm saying everything is hunky-dory, but that is the LFPR, the labor force participation rate, is still about 2 percentage points higher than it was in the average of the last year. What does it mean? Well, there's a lot of data in the CMI. If you look at it from a perspective of economic analysis, it tells you that people are worried about the pandemic, okay? That they are withdrawing from the labor force. It is not just there are no job. Why do I say it? Because most of this rise is in the formal organized sector. And again, to give you the bottom line, if you dig into this data, it turns out that these people are likely the better income, higher income, who have wealth to fall back on and who are educated. So it is not that jobs have disappeared. It is that some people are being more cautious going back into the job market. Again, I'm not saying that's the 100% full story, but a lot of it is that. So bottom line, again, what I said, I think to me, it tells me that my original forecast from May, which was minus 5%, but I would say with a downward bias, is probably the most optimistic forecast of anywhere in the world on India. And that seems definitely, this data tells me that that is
saying minus 5%
more
for this
likely
financial
than it
year,
was before.
if you're saying, yeah. Okay, so I think that you've summed it up well, Mr. Virmani. So you're saying for this financial year, we're likely to end at minus 5%, which the bigger
Minus
picture,
5 to
looking at what's
minus
happened
10.
to the world, that we had a
Minus 5 to
severe,
10.
extended lockdown. Well, that's
Yeah,
quite a
well,
range. Minus 5 to
No,
minus
the
10 is
point
quite
is,
a range,
okay,
but yes.
let me
Okay.
explain the range. Historically, I give a range of 0.5%. In
No,
the
sir.
previous lower crisis we've had, I do 1%. Now I'm giving minus 2.5. I just told you other people are saying minus. I am saying I'm sticking to my original minus 5% plus minus
Yeah,
2.5%.
Okay. Okay, you know what, why these numbers are important, and I keep coming to that whenever I speak to economists and finance experts, is because it actually impacts people's lives. Mr. Garg, how do you look at the next few months? Because these are crucial. Everyone's going on and on about how the festive season will be a game changer, where people will come out. There are worries that, the number of infections could also increase as people go out more and more. Now, restaurants, etc., cinema halls will be opening. How crucial, in your view, are the next 3 months?
In next 3 to 4 months, I would watch for a couple of things very closely. One is capital investment coming back. We have had very bad sort of downward trend in capital investment, infrastructure and all. That is still not anywhere close to the normalcy. It need to come from the government and the private sector. This is one thing which I'll watch very carefully. It gives me a lot of worries still. The second thing which I would watch very carefully going forward is credit sort of turning back. We still continue to have a very low level of credit growth, despite the government supported, guaranteed credit flows to MSMEs and all. Even that 3 lakh crores is half dispersed still. Growth is only 5.5%. And from March to now, in 6 months, we have still negative growth of credit. So that worries me, and I would see it is also related to the investment story, the capital formation. The next thing which I would watch very carefully is the labor participation rate, as well as the return of the salaried jobs. The CMI data brings out clearly that we have lost as much as 2 crore salaried jobs, and they are still lost jobs, while unemployment rate has come down.
Absolutely.
But the salaried jobs are not there still, and the labor participation rate has still been lower by about 2.5%, which gives you an overall employment rate to be lower than what it was last year. So this is another thing which I would watch very carefully. The last thing which I would again see very carefully is whether the government is coming up with a stimulus, which is capital expenditure and also some demand supporting measures.
Yes.
If we get these things right, if these trends turn towards positive side, they have any positive growth over last year, I think we would be getting to normal. My own sense is that in the fourth quarter, we would be very close to the normalcy of last year. But these 4 indicators, if they turn out to be better than what they are today, I think we are in a better space.
So if we, yes. So I think to sum up, we have the momentum. We must not lose the opportunity over the next 2-3 months. And if there is a fiscal stimulus coming, or any kind of a stimulus coming from the government, which there seems to be indications that there is, now is the time. I want to thank all of you for joining us in this leg of this special show that we're doing. We're discussing the Indian economy. Is the glass really half full? Is the worst behind us? We'll take a very short break, but when we come back, I want to talk about a very, very crucial indicator of why there is this sense of optimism. Remember real estate, beaten, battered real estate industry? Well, they seem to have shown some spark in the last few months. In fact, residential sales have gone up nearly 3 times month on month over the last couple of months. So what's going on? We're going to find out after this very short break.